Hi, I'm Jim Jubak, and welcome to my YouTube video for April 7th. It's another gray, cold, miserable day. I was just thinking about the effect of weather and animal spirits in general on the market. We are, it seems, in a gray time. You know, we've got a horrible war in the Ukraine, but it's also just, gray. It's the transition between winter and real spring, which comes in May. I think that there are ways in which this sort of atmosphere depresses spirits in the stock market, and I think it's something to bear in mind as we try to figure out what we want to do about stocks right now. If you like this video, please give us a thumbs up, like it. If you want to see more of them and get notification of when they're going up, subscribe to my YouTube channel. We're doing about 3 a week. If you want to see more and more, you can go to my free website, jubakpicks.com, and that gives you 3 portfolios as well as a lot of stuff on the market, trends, and individual stock picks. If you want more, 6 portfolios instead of 3, go to my subscription site. That's jubakam.com, and you'll find links to all those down below. Topic is time to buy oil stocks on the dip. We've had a pretty good dip over the last few days, that if we look from today's price on the 7th back all the way to April 4th, we see that US benchmark, West Texas Intermediate, is down about 7.2% during that time. Brent, the international benchmark, is down about 7.2% in that time. A lot of it is, it ran up to 105, 107. People said that was too high. We saw trading opportunity, optimism that maybe the war in the Ukraine was not going to last as long as people thought, suspicion that Russia was successfully evading the sanctions and therefore was not going to put a big crunch on oil supply as expected. All those things have led to a retreat in oil. And one of the things I would say to you is, if you were looking back at January and saying, why didn't I hedge oil then? I think this is another good opportunity to buy oil as a hedge on a return to increased activity on the war fronts in Ukraine, more sanctions. But on the other hand, we've also had reports of that basically Russia is being very, very successful about avoiding the sanctions through China and India and other intermediaries. And Bloomberg today said, hey, it looks like Russia is going to do about $320 billion in oil exports this year, and that'll be up a third in value from 2021. A lot of that because of not increased volumes, but increased prices. The stocks that I added in January to hedge against the war in Ukraine and disruption in the global energy environment because of sanctions is that they've done really, really well. Let's look at some charts. Okay, this is a chart for crude. You see it's been very spiky. We got a big spike up there out the outbreak of the war, and now we've been down. And I'm looking for another turn back up because I think that all of the features that made this rise likely are about to be replayed. But let's now also look at some of these individual stocks. This is ConocoPhillips, or Conoco, and you see that it's had a little bit of a dip. We're not talking about a lot. In the last week, we've lost about 3.5%. That still puts me up on this position about 20% since I added it on January 21st. I would look to buy this one right here. One of the things about this and the next stock I'm going to talk about, Pioneer, is that they promise to basically control their expenses in terms of new drilling and development, and to add a kind of 2-part dividend. That part of it is a base dividend, and then there's a variable dividend. We're going to see reporting dates for these 2 companies in early May, and I think that there will be a lot of buying to get in on the potential variable dividends. This is Pioneer Natural Resources. Same pattern, basically. You've had a little bit more of a drop, about 6.2%, and it's only up 17% since I bought it at the end of January. And let's look at Cheniere Energy, ticker is LNG. The very heavily liquefied natural gas stocks, producers, Cheniere is a liquefier of natural gas and then shipper onto ships. They haven't dropped very much because basically natural gas prices are really, really tight and high. So it's only down about 0.2% in the last week. Now this is where the biggest gains have come since I put on these hedges. This is up about 36% in that time. Last one is Equinor. This is the Norwegian oil and natural gas company, perched right outside of the European Union, which needs a lot of natural gas, has natural gas liquefaction facilities and pipelines and connections. So it's a good bet on that. It's down again only about 2% over the last week and up about 34% over the last, since I bought it in January. The last one is the Energy Sector SPDR fund ETF. That sort of conglomerates everything. We're talking about a tiny drop of about 1.4% in the last week. And I bought this on the 2nd of February, and it's up about 13% in that time. So which one of these do we want to buy? I think if you're looking at continued gains from the rise in raw materials prices, I would definitely look at Equinor and at Cheniere LNG. If I was looking for a dividend, I would look at ConocoPhillips and Pioneer. Those are the four, the mix of the four. And in my next video, I'm also going to give you a new LNG play if you've got a really long time horizon. Anyway, thanks for watching. If you like this video, like it, subscribe to the YouTube channel. If you want to see more of my stuff, you can go to my free site, jubakpicks.com. If you want more, which is 6 portfolios instead of 3, go to subscribe to my paid site. That's jubakam.com. Find links to those down below.